Welcome, trading buddies. It's time again to go through charts and chats with me, Gordon Scott, CMT. I'm glad you're here. The S&P 500 and the NASDAQ 100, they're looking like they're nervous. They're showing some real signs of nervousness. I want to take you through them. Also, it's interesting to notice that small caps and micro cap stocks are on the rebound. I'm going to show you the chart that tells you that and why and how you can use that chart to know whether or not it's time to go, really hunting for some excellent trades that make you a lot of money in a short period of time in very low price stocks. It's unusual, but we're in a situation right now where that might be something to consider. So we'll talk about that. And also, how can you be wrong but still make money? Yes, I'm talking about my IWM put option trade that I've been doing for the past 3 weeks. I'm going to walk you through that and show you how, even being wrong, I'm still making money on that trade. And if I ever do get to be right about this, it's going to make me a lot of money. But for now, we are 2 weeks away from my doomsday scenario, and it is actually playing out according to expectations. May not happen. We'll walk through that as well. But let's get started right away. I'm going to share my screen, and hopefully you'll be able to see why I find this chart right here. That one. No, that one. So fascinating. Okay, so let me go ahead and share my screen. We'll go through all of these interesting charts I have. And as always, don't hesitate to chat in your questions in whatever platform you happen to be watching on. It's all good. And let me make sure that I can share that you can see the screen I'm sharing. If you wouldn't mind anybody chatting in, let me know that you can see the IWM or IWC/SPY trade chart. Anybody, are we okay looking at that one? All right, well, I'm going to assume we are. You're going to have to tell me if you can't see my screen share. But what we're looking at here is, yes, thank you, Mike. What we're looking at here is IWC. What IWC is the microcap, Russell Microcap Index. Microcap means, even smaller than small cap, right? Less than $300 million a year in revenues. In market capitalization. Share price times number of shares in the outstanding trading area. It is zoomed too large. Is that any better? Okay. Let me go full screen. That's still too big? Okay. Well, hopefully you'll be able to, it's fine. Okay. Sorry about I've got a very high resolution screen I'm coming off of. So if you might need to size your window or something, I'm not sure if that's different for one person or another. It's the first time I've run into this. Hey, Helen. So look, what I'm looking at here, you've heard me talk about IWM. That's the ETF that covers small cap stocks. IWC is a lesser known, but still heavily traded enough stock, or ETF rather, that tracks a group of stocks that are 300 million in market cap or less. So they're small companies, right? Really small, or at least the market values them as small companies. Not quite startups, but not the 500 person company that's typically 500 to 1,000 person, maybe even to 10,000. That's typically in the IWM. These are smaller concerns, and what they are is an excellent representation for low-cost stocks, what many people would call penny stocks, what the SEC calls penny stocks, stocks that are under $5 a share. Now, what's in that index is not specifically $5 a share stocks. It is instead, yeah, baby giants, says Helen. Well, okay, we can go there. But what we're talking about really is stuff that is, below $5 a share, but above $1 a share. We want a proxy for that, an index that tells us whether that whole class of stocks is interesting to investors right now. And in this chart, IWC slash SPY, we have it. So if you go to TradingView and you type in IWC slash SPY, what you're doing is you're dividing IWC by SPY. And that gives you the relative strength of one, whichever one comes first, over the other, whichever one comes second in your slash thing, right? So all this says is that IWC is outperforming SPY if it is above its moving average. So I have a 10-day moving average. That's that little blue line there. And if IWC is above that moving average, then it is doing better than the S&P 500. Okay, and we care about that because if in fact it's doing better than the S&P 500, that means there's enough people putting money into that class of stocks. That is a huge tell. We care about that because that says, look, if money's going down there, then I can go down there and try and make money myself. Now, somewhere I think towards the end of June, we're going to teach a class. I believe it's scheduled, but you may not have seen any advertisements about it yet on any of the Telegram channels for the low-cost stock class that I'm planning to do. And it is really, this is a class that I have not taught with Actions to Wealth before, but it is available on, well, not the same class, actually. The first iteration of this kind of information is available on Investopedia Academy. You go there, it's like 99 bucks. That's something I did 4 years ago. Very first time I ever taught just on that topic. But this class is different because it's refined, it's expanded, and it's, well, a lot more valuable. And it's one of the three major strategies I follow all the time. And the way I follow it is if IWC is below SPY, if it's below this moving average, right? If it's not performing as well as the S&P 500, then I don't want to be trading those kind of stocks. So as you can see here, from the middle of March, actually middle of February, all the way until now, it's been a little suspect trade. I haven't been focusing on these kinds of trades, but we have popped up above it here just recently. And so what we're looking at is the potential for this trade to get started again, for this whole class of trades to get started again. So this is what the micro cap rebound is based on, the idea that, hey, for whatever reason, more money might be heading there. And so we want to check out the possibility of finding some trades in that area. I'm going to show you how to find trades that work there and a little bit about it. I can't go into too much detail today because it takes more time, but that's certainly what the class will be all about, is all the things you need to know. This is a simple, repeatable process. You got to know what kind of time frame you're trading in, what kinds of stops, what kinds of entries and exits seem to work best in this. This whole area, $5 to $1 stock, is a completely different asset class. Well, okay, it's still stocks, it's still major indexes, it's over. I'm telling you, it trades differently from everything else, but that's exactly why you ought to be interested in it and want to learn it. So I trade large cap stocks in a certain way, and I trade options in a certain way. You've been hearing me talk about this if you've been coming to these presentations every Monday morning. And I also trade low price stocks when they're in season, right? Well, that's what we're talking about. This chart says they might be in season now, might be coming in season. So they're worth a look. All right, now let's go back and look at the charts here. I want to show you how things ended up last week. All right. Notice that the S&P 500 and the NASDAQ 100 both had these subtle new highs over the course of the last 10 trading sessions, and their respective volatility indexes, VIX and VXN. See that? These things had higher lows. Now, these are negatively correlated. The volatility indexes and the larger, major broad market indexes. So if one is making a higher high, the other one should be making a lower low, right? When that doesn't happen, when that is somehow not according to expectations, that's something you want to pay attention to. Well, I'm paying attention. VIX is getting higher. VIXN is getting higher. S&P and NASDAQ are both getting higher as well. This is the nervousness I'm talking about. Why is it that these the volatility indexes are not going lower? Okay, what the volatility indexes represent, by the way, is the cost of options. So if options are relatively more expensive, then these things go higher. And so you can look at these kind of as fear factors, fear indexes, because if somebody's paying more money for an option, then that's their way of saying, I expect options prices to potentially fall. And more importantly, the prices of options are set by sellers, right? Now, it's not, they don't arbitrarily get to set, but they're the ones that make the offer to the buyers. And if the buyers say, forget it, I don't want it at that price, well, then they got to come down. But they start it. They peg it at some place where, all right, here, this is where I want to sell it. And if an option buyer comes along and says, I'll buy it there, great, they'll leave it there. If a bunch of people buy it, then, demand's high, I'm going to raise that price. So in other words, sellers are setting the price according to what the market will bear. And if the market will let them, they will charge more money. And they charge more money when they particularly are worried about the possibility of fast price moves. And prices always move faster to the downside than they do to the upside. Okay, market makers understand that. And so they have to protect themselves. If they're going to sell you a put option because you think the market's going down, and they're well, okay, you want to buy a put option, I'll buy a put option. But you know what? You got to pay this much for it because I see it too. I think the markets could drop, and I don't want to get soaked. I don't want to be on the losing side of your trade. So you're going to give me a piece of the action, and you're going to do that by paying a little bit more money. So that's what's going on in these prices, and it's reflected in these pricing differences. Well, if we're hitting higher and higher prices, typically what happens is that VIX goes lower and lower, because if we're hitting higher and higher prices on the S&P 500, we're usually going lower and lower on VIX because people are getting less and less afraid of the price dropping. And when all of a sudden it changes, when all of a sudden VIX starts going higher, even as S&P 500 is going higher, then that tells you that people are worried. Market makers, option market makers, are worried about falling prices. Higher volatility implies they think higher prices, lower prices. Sorry, lower prices, faster moving, lower prices, falling prices. So we see that. We see that over the past week. Those prices made a higher low, holding on to that higher level of volatility. Now, they could easily go down. There's not a guarantee that they're going to stay this way. But the fact that they're there is a condition. It sets it up and says, hey, we're possibly going to run into something. Now, here's another chart. This is historical volatility. And historical volatility is just, price movement by average true range, right? These are Keltner channels based on average true range. Notice that the NASDAQ 100, see the edges of the 4 ATR, that's what these little yellow circles are. Do you see how they're kind of contracting? If I look at the NASDAQ 100, see, it was kind of big before, and it's getting smaller. It's just kind of squeezing in. It's a little like a Bollinger Band, but not exactly. However, if I take the 6 biggest stocks, okay, let's see if I can get that a little bit more. So this is Apple and Microsoft and Facebook and Google and Amazon and Tesla, okay? Those are the 6 largest stocks in the NASDAQ 100. If I take an equal weighted portfolio of them and I look at the outer edges of those 4 ATR, do you see the difference? Do you see how these are actually expanding? It's super subtle. It's super subtle, but it's there. You've got the whole 100 kind of contracting a little bit, and you got the big six expanding a little bit, meaning that the price action on the big six is starting to get more volatile. Now, a big reason for that is that they all just went through earnings. And so, you see big candles on earnings day. However, it also means that people are uncertain about the true valuation of those six. And it's fascinating because every single one of those six, every single one, outperformed their estimates. And 4 of those 6 beat their estimates by more than 50% of the expectation. So if they were expected to turn in, $5 per share in earnings per share, they turned in $7.50. That's what I mean by 50% above their expectations. Well, those are huge numbers, right? Apple blasted through 50%. They were like 60%. And they said, we're going to buy back $90 billion of our stock. 90 billion, right? Any other quarter that kind of news gets released, and that stock jumps 10% by the next day. What happened with Apple? It was up about 3% to open after earnings, and it sold off entirely. I think I have that chart, in fact. Do I? Do I not? Yeah, I don't think I do. Well, I can go back here and do it. Let me just show you. It is, to me, this is the state of the markets here. I'm going to zoom in so you can really see it. Just look at this over the past couple of days, right? What's happening here? See how this is the day after earnings, the big red candle. It jumped to a new high. Based on its news alone, that's what it should have done. It should have been even higher than that. But it sold off entirely that day and the next day. Now we're sitting right down here on support. It's going to be very interesting to see how it opens here in just the next 45 minutes. Will it, in fact, hold that level and go up, or will it drop? All right. So those are the situations. Well, there's one more chart to show you from last Friday. Okay. So the big stocks, another one of the last of them to report, in fact, was Amazon. Amazon, again, blew through its earnings. 60%, I think, also, like Apple. I mean, it was one of their better beats ever. And that totally makes sense. Everybody is, have you noticed in your area, maybe in your part of the world, it's different. In the US, in several areas, I'm seeing a lot of renovations happening in malls. So shopping malls, they were having a tough time anyway, come 2020 or 2019. People less and less were going, and rents were too expensive and so forth. They are revamping. They are building office instead of a lot of retail shops. You got professional offices, doctors, lawyers, medical offices, whatever, going into those places. And then you've got them, some of the remaining retail shops, restaurants, food court kind of stuff. In other words, they're bringing professionals into what used to be a mall space so that they've got a semi-captive clientele. You got people that I work here. Oh, I want to go for lunch just down here to one of these, right? It's just like New York City and probably a lot of other big cities around the world. In New York City, you have these huge high rises, and then tons and tons of people work at them. And what is the rest of? I mean, it's New York City. There's everything there, right? But what there's a lot of is delis, and delis now, especially the ones that want to stay alive, they have to be delivery services. But pre-COVID, it used to be that you all these office buildings, and then people walk out onto the streets and they go to delis or drugstores or whatever, and then they come back and go to work. And then in the evenings, nobody's out shopping, so they're clicking on Grubhub or Seamless or one of these delivery services. Now, I know COVID, especially in New York City, it's like, forget it. Nobody's doing any of that anymore, but it's slowly working its way out. This past weekend, tipping point for me, I went to a restaurant and it's like a Brazilian steakhouse. No masks, no restrictions, back to normal. Now, it's most of the restaurants in the area where I live are not like that, but this one was, and it was in a college town county, which I thought was a little tighter restriction. So I was shocked, but that's what it was. I went there, had the mask ready. Nope, nothing. And no, I didn't get COVID. So um, yeah, let's see. Helen says, I can see complete shutdowns here as if closing for good, especially smaller restaurants. Yeah, yeah, yeah. Right, right. There are a lot of businesses that are closing for good. But yeah, I just feel like it's possible that, I know places around the world, India has this new surge going on. Uh, People are calling that India's second wave because it lags behind the US. But other people are saying, oh, there's new, um, you know, anyway, I'm way off. What's going to happen with COVID? So far, the market doesn't think that COVID's going to take over everything. It might be that those volatility indexes are building in a little bit of extra because they're worried about the potential second wave, as well as just the whole earnings announcement stuff. It's possible. I mean, the VIX and Vixen were elevated. We're in that divergent mode that we just looked at for a whole month before the COVID shutdown, or like a month and a half before the COVID shutdown. So it's quite possible that the option market makers are just there. However, all of that dynamic, what did it do? Boom! Everybody's buying online now, and Amazon's the biggest benefactory of that. No, whatever. They're getting the most benefit out of it. All right, and yet major bearish engulfing kind of candle. Opens high, closes low, engulfs the candle before it. Um, and both of those, selling, that totally looks like a top, right? We'll see. It may not. It might keep going because those earnings announcements were so good. However, look at what happened on the same day. This is all Friday, right? TLT, which is the bond ETF, is up. Not a lot, but it is up. Okay, all by itself that doesn't mean anything. It's just TLT is just doing whatever interest rates are, the opposite of whatever interest rates are doing, and interest rates dropped a little, so the bond market went up. However, when you see this in conjunction with a lot of other fear signals, or sell the news, right? Buy the rumor, sell the news. That's what people say in large institutional investing circles. They want to sell good news when they want to take profit. Why do they want to take profit when you have good news? Because good news attracts a large number of buyers, so they can unload a large number of shares without running the stock price down a lot. They can kind of hold it up there while they're selling a bunch and still take their big profits. Why would they want to be taking profits right now? Right? Let's go back 3-4 weeks ago to the presentation that I did. I guess it's been 3 weeks now, on the 56-week pattern. That's what the 56-week pattern is all about. They buy, they hold on for 1 year. That's their minimum time frame, and then they start selling. And what are we seeing right here? We're at the 1 year mark from the bottom. We're already there. We're not at the 56-week where the critical mass of a whole bunch of sellers are all coincidentally wanting to sell at the same time. We're not quite there yet. Another couple of weeks. But already it's starting to happen. Every single one of these good news reports, these big companies that have come out and beat their earnings, so what's happened is that the first day right afterwards, investors sold the stock. They're selling the news. So there's this huge profit-taking attitude. Doesn't matter how good the earnings are, people want to take profits. That's the condition the 56-week pattern predicts. So it is coming about. Will it turn into a full-blown sell-off and ultimately lead to a bear market? Don't know. In fact, I think there's a lot of evidence that it's not going to do that. But hey, what if those COVID headlines within the next 2 weeks all of a sudden say, new second wave, third wave, whatever, right? What if people start jamming hospitals in Italy all over again? You know where it's going, and it's going to be ugly. That's what the 56-week pattern is. It's like you got this collective nervousness going on, and then a bad, really bad headline hits. If those two happen together, it's like, you know, uh, uh, natural gas and a spark, just explode right then. So the conditions are tight for it. Well, when we are in those kinds of conditions, if you see TLT moving up, you pay attention, because that means people are trying to head to safety. TLT is a horrible investment. It's long-term bonds, and they pay less than 1% interest, right? Why would anybody want that? Well, if you thought the market were going down, if you thought you were going to either lose money or have a predictable gain of a small amount, you take the predictable gain. But only if you believe you're about to lose money from falling prices. That's why we care about watching TLT. Even more important than TLT is this next one over, XLU, the utilities sector. So when the utilities are moving up and the rest of the market is moving down, that means big investors are headed to safety. They're looking for safety, right? And why safety? Well, because utility stocks are low volatility. They don't, jump around a lot. Plus, they pay a nice dividend. So if you hold on to them for a quarter or two, you got a guaranteed dividend payment and maybe a little price appreciation. But even if you don't get the price appreciation, it's not going to go down as far. So they're a fantastic place to sort of wait out the storm, to hide from a bear market. In fact, the utility sector predicts the bear market. When the utility sector outperforms S&P 500 for 2 consecutive months, during which period of time volatility increases, then that predicts a bear market. 90% of all bear markets have been preceded by that signal. Okay. There it is. Utilities heading up on Friday while the rest of the market was, mildly down. So, and then last of all, huge up move in the dollar, the US dollar, right? Why would the dollar be interesting to people, right? I mean, the Biden administration is about to spend, they got the approval from Congress to spend $1.9 trillion on top of everything that's already happened. And they're already getting out there to suggest another 1.8. I mean, it is just crazy printing money. And the Fed, don't get me started. They're not talking about specifically quantitative easing, but they are. I mean, they're doing that all the time. Their money printing is just like crazy. And yet dollar jumps on Friday. Why? Because when you get out of Amazon, if you're a US stock investor, a large a hedge fund or a mutual fund or whatever, what are you doing when you pull your money out of that? You're putting it into cash. You can think of stocks just like you think of currencies. Currencies have a pair, right? It's euro, US dollar, the pair. You get out of one, you get into the other, vice versa. Or when you go long the euro, you're bringing euros into your account and selling dollars away from your account, right? When you sell stocks, you're doing the same thing. You're short the dollar when you buy stocks, and when you sell stocks, you're short the stocks and you're long the dollar. You move your money from stocks to cash, and when a whole lot of people do that, it makes the dollar value, the value of the US dollar, go up because there is a demand for cash, specifically US dollar cash, right? Because it comes out of US stocks, it goes to before it goes anywhere else, if it's foreign investors outside of the US, that is, then that's what happens. But before it goes there, it has to stop as greenbacks first. So we're seeing cash, utilities, and bonds all up on a day when the markets were selling off, even after a fantastic week of earnings. Isn't that amazing? Yes. So Helen, a couple of good comments. I saw recommendations to liquidate stocks now and buy back later. Yeah, that's exactly what I'm talking about with, I told my daughter, yes, I did, on Thursday, move your money from, she's young, so she has this uh, retirement fund, retire in 2055 or whatever it is, she has it set to that day. And which means that the fund underneath has like 85% growth stocks in it. And so I said, move it to cash. Not because I thought it was going to fall imminently, but because the minimum time she can be out is a month. So I said, get out now, the end of April, and that way you can get back in the beginning of June. At the worst, you're going to miss the potential for, May to go up, but it'll probably just go up a little because we got all this sell the news stuff going on. It probably won't go roaring higher. However, there is the possibility that it could drop. That's the doomsday scenario I've been talking about for weeks. And it could drop. And my hope is that if it does drop, come June, at a minimum, she can start looking for where to get back in. Now, it's quite possible that if it does drop, if the drop only lasts 4 weeks, right? May 14th to the middle of June somewhere, which is kind of what I'm expecting right now because of that IWM chart I showed you, right? Microcaps aren't outperforming the S&P 500 if people are super panicked and afraid. So I showed you all this right here, but we've still got IWM outperforming SPY. So, what's that all about? Well, what that is all about is, I changed that to Apple. What that's all about is people are looking for opportunity. They see the big ones faltering, and so they're going after the small ones. That is also actually a sign of a top, because while it's true that through a bull market, investors will keep trying for micro caps and small cap plays. At the end of a bull market, then people get tired of the fact that the big companies just aren't going up. I got to find something that's going to, make a big hit. I missed that huge run where I could have got Tesla at low and sold it much, much higher. So how am I going to get? I'm going to go looking for the microcap stuff that can grow. So they get more risk seeking and they try to, find this big hit at the last. And that happens right at the top of a market, very specifically because that's kind of the last gasp for people. They get in, they get ruined by it, they get out, they're like, oh, forget it, I'm out of here. And so that contributes to the selling in big cap stocks. So actually, even though that's a place to go looking right now, and it is good, you got to be careful because that's also a sign of a potential cyclical top. And so how do we navigate that? What do we do? Well, let's look at where we are right now. This is the 15-minute chart. And this is actually very interesting to me because I was looking at this an hour ago when I came into my chart room here and started to look things over. Here is the NASDAQ futures. This is the weekend, the start of, no, that is not the NASDAQ futures. I'm sorry. Let me get those up. Q futures, E-mini NASDAQ. Yes. See, we want to compare these. All right, there we go. There's the weekend break or the there it is right there. Okay. So no break, no gap, that is, right? Coming from Friday into Sunday night, US. And what are we doing since then? Slightly drifting higher. Here is the break on Aussie yen. It's a jump up. And since then, it's been going higher. It's been drifting higher. So that's actually a bullish looking posture to open. All right. Right at this moment, it looks like people are fine with getting ready to go ahead and buy more stocks. However, Notice the past 45 minutes on Aussie yen. See that sort of, we were trending higher, but then we failed to make a new high. We've come back down. We're sitting right on support. I'm very eager to see what's going to happen here in the next 15 to 30 minutes. Are we going to break support and come lower? Because if we are, that is signaling, and it is ticking lower even as we watch, that's signaling that globally we've got some sellers out there. Now, I don't know if you remember last time we had this situation where the NASDAQ, last week, we had this situation where the NASDAQ futures were drifting lower, but the Aussie yen was working its way higher. And let's just review, of course, how that shook out for last week. If I just go back to a daily chart here. So yeah, it's 1, 2, 3, 4, 5. Right there. See that? That first day last Monday, it did go up. Not much, just a little. And it was a very tight, look at those tiny little candles. That was earnings week, the big earnings week, I should say. I mean, earnings season started 2 or 3 weeks ago back there, the blue marker. But this is the week that Apple and Microsoft and Tesla and Google, all the big, Facebook, all these companies reported earnings. And yet those candles are tiny. That's not a good sign. That's I mean, if they're tiny, they should have been going up all that time. This is just a bigger representation of sell the news. So last week we had this situation where the Aussie yen was going lower and the NASDAQ was drifting higher, and then the last little bit the Aussie yen curled up. And do I have that right? Yeah, the Aussie yen curled up, and so it kind of foreshadowed the idea that we were going to go higher. Well, we did, but the rest of the week we dropped lower. All right, right now we're looking at the possibility we've got Aussie yen on support, and the NASDAQ is drifting higher, but it's just that tiny little range there, right? So the big question is, will this support on the NASDAQ give out? If the Aussie yen breaks its support and starts trending lower on the 15-minute chart, will the NASDAQ follow suit? They're typically 75% correlated. So one starts going, then the other tends to follow it. And we'll see if that Aussie yen holds support. But because if it doesn't, then it is leading. It is saying, no, we're getting out of here. We're selling, and could in fact foreshadow what the NASDAQ decides to do. So we'll revisit that. I'm going to turn this back into the 15-minute chart up top here. Well, we'll come back and revisit that before the market opens. Right now, though, I think I want to take some time to, before I can do anything else, I got to show you. I was talking with you about the utilities sector. This is the relative comparison between S&P 500, the blue line, and the utilities red line. Notice that in the past month, I showed this a couple of weeks ago, but it was early on and you couldn't see what the whole month of April was going to do because it just had a day or two. Well, there's the whole month of April, and the S&P outperformed XLU for the entire month. Also, notice that the average true range in the S&P 500, it's hard to see, but it declined a little bit. If I get that little dashed line right on it there, then maybe you can see how it kind of came down through the month, just very subtly went lower. So that resets the clock. That says we're not going to get a bear market until we get a whole nother 2 months of the opposite kind of behavior. So that's one of the reasons why I'm looking at this and I'm thinking, my doomsday scenario, in order for it to be perfect, to be right in front of a bear market, then we should have expected this average true range to actually go higher, and we should have expected utilities to outperform, the red line to look better than the blue line, from this sort of starting point right here, better than the blue line for the past month, but it wasn't. So what that tells me is, although doomsday could still come, it's just a mini doomsday. And what that also says is there's a fantastic buying opportunity on the other side of the 4-week drop. So so we'll see what plays out, but that's the important thing. You really want the 56-week pattern to be clear. You want to see some definite signs of selling, and then you want to see it stop. The signs that the selling has somehow stopped and has returned. You'll usually see the VIX doing the opposite, right? VIX prices are going down, but VIX is not going higher. VIX is starting to go lower, even though prices are still going down. That's usually your signal to say, okay, there's a major trend change, or in this case, resumption of the long-term bullish trend. So that's what we would be looking for the rebound in June or July timeframe. There's some more 56-week pattern stuff that will continue to light off because COVID came back so fast, multi-month, then we could have multi-month selling, which is why I've called it doomsday, because it's quite possible that not only will it, when it starts dropping in May rather, when it starts dropping, it could be the case that people just say, you know what, I'm done with stocks, and they just keep selling and selling and selling, and it just keeps deteriorating all through the summer. It's very possible we could see that environment. All right. Now then, let's see. I think the thing I want to show you now is what I was talking about before. How can I be wrong but still be making money? Well, I've been expecting doomsday to come, right? Among the reasons, I really like to watch IWM as small cap stocks compared to the larger cap stocks, right? So here's the small cap S&P 500. I mean, the Russell. It's not compared to anything. It's just itself. And notice that the Russell hasn't been making new highs. We've got almost a head and shoulders pattern here, or triple top or something. It looked like maybe we're going to come back and make a new high, and yet we sold off, just like Apple, right? So that weakness is still there. Now, I thought somewhere back here that it was just going to keep going down, but it hasn't. Since then, it's gone back up higher and higher. So I've been wrong about that. But how is it that I've been able to make money even though I've been wrong? Oh, looks like yeah, Gaurav's asking, is it buy the dip or wait for some time? You don't. I don't recommend trying to buy the dip now. If you're on the sidelines, now's a good time to be on the sidelines. Like I said, I told my daughter, move your money, and that's a personal indicator to me. I told her to move her money a little bit late, but early on in the whole COVID thing, she got out, and I told her get back in. Just a month later, and she got a fabulous ride. That one change, get out this day, and then 1 month later, get back in. Early March, get out. Early April, get back in. That increased her holdings by 10% over what the S&P 500 did. So she had a great year last year, making one trade. So that's the kind of thing. It's the my daughter signal. What am I telling my daughter to do? She knows enough about stocks because she grew up in my household, but she doesn't like looking at charts all day like I do, and she doesn't watch it. She says, "Dad, when you see it, just tell me. I'll do it." And so she does. And hey, she outperformed by 10% just by making a single trade. I mean, so that's why I share it with you. I say, look, I told my daughter, that's the signal. If Gordon tells his daughter, then that's the easy trade. That's the, hey, move to the sideline. Well, okay. So the Russell 2000, what have I been doing? Well, as I said, I bought put options clear down in the 200 area. Well, let me just bring up the spreadsheet. I'll show you. So back on the 14th of April, I bought a May 20 210, paid $2.94 for it, 3 contracts. The total cost of that was $882. I gave myself 50% risk. That is, I'm willing to let it. I'm willing to lose $440 on the trade. I don't want to, but if it gets that low to where I'm losing that much, I'm out, right? But I also sold this is what is called a diagonal put spread. So I also sold April 16th options. So I'm buying these longer dated ones, but selling these shorter dated ones. And I sold it for 36 cents. Well, it didn't drop all the way to 218. IWM did not drop to 218, and so that expired worthless. So I got to keep all 36 cents. That was 12.2% of my initial trade. So I've collected that. And then I did it again the next week. I got 38 cents that time. Now I have 25% of my initial cost collected. So now my risk, in order to lose $440, it gets harder and harder because I've reduced my cost basis. See, and then this one here was last week. For whatever reason, selling a 220 yielded me 54 cents. And so I got a big old jump there. Now, that's exactly what I'm going to look to do today. Look for the option that expires May 7th. We'll see what strike price gives me, something around 50 cents. And when I do that, then I'm going to be able to have something like 75% of my initial costs collected. And even to, I only have, I can go all the way down to a value of $57 before I'm losing 50%. So that hopefully next week I'll have this whole, whatever it is I've been able to collect. But see, that's the thing. I've been collecting this. I've been making money. Now on net, I'm still down. It's true. You know, the net, I'm still below 882. But all it has to do is go down a little bit, and that changes. That changes a lot. I have collected a total of $384 against the 882. At the rate I'm going, I will end up collecting all, if not more, of the 882 by the time the option is, you know, and so even if I'm wrong, I will end up making a little bit of money. A tiny little bit. I mean, percentage wise, you know. But if I'm right, if all of a sudden it turns down and IWM starts dropping over the next couple of weeks, well, then this is going to be a fantastic trade. And so that's what you like. It's not that you can't be right on every trade all the time. You want to make it, though, so that when you're wrong, you have a limited amount of loss. And you love it if that loss amount is very small. Whereas if you're right, it's very large. And especially if your percentages are, you know, 50-50. If I can be right 50% of the time, and when I'm wrong, I lose a little, when I'm right, I make a ton. That's a winning trading system. Over many trades, you make that trade all the time, right? But look, I want to show you here that I've done the same thing on Apple. 14th of April, I bought a June 105 put on Apple. Bought it for only 95 cents because it was so far out of the money. Bought 5 contracts, total $475 put into it. I'd like to not lose any more than 237 if I could. But each week I've been able to sell, in this case 16, in this case 16. So I was 17% collected off that first week, 33% cumulative. But then last time I got a 50-cent option and all of that. So there I am, 260 and 160. That's $420, right? So 420 against the 475 that I've collected. Compared to my initial risk, I'm actually positive compared to what I was looking for. You know, I'm 182 extra to give before I could possibly lose 137. By this week, I'm going to do it again. Just today, I'm going to throw that on again. And when I do, if I manage to collect that, whatever I manage to sell, if I manage to sell, you know, another 50 cents, probably not. Probably I'm only going to be getting about 30 cents on this one. But when I do, then I will have collected more money than I paid. And I still have all the way till June to go. So I can keep selling this week after week after week. And even if I'm wrong, even if Apple keeps going higher, I'll be able to make good money on it. So that's how to be wrong. And now that if you're not an option trader and you don't know about how to do this, it's not as hard as it looks. I'm sure it probably sounds complicated, but I am going to walk you through that step by step in the class that I'm about to teach at the end of May. Last week in May, if you haven't seen the advertisements for it, you'll probably be seeing them soon. Yeah, how do you know when to sell your puts? Helen's asked. Great question. The answer is every Monday. Not about the timing. There are some timing things you can watch for, but in this case, I'm just telling them every Monday. But the process of doing that, I'm going to walk you through step by step as part of the class. I don't know what the cost of the class is. It's what, a couple $100, I think. That's what the other one was. So I'm expecting it. I'm going to revisit what I taught in the class in January about trading personalities and show how those relate to option trading. But then I'm going to walk you through this particular trade and a few others in terms of a style. So you'll know how to trade options. I mean, the great thing about options, it's like a lot of people wanted to buy the cryptocurrency that was $1 and then went to 10 or 20 or whatever dollars. They want to catch that 2,000% gain. Yeah, those are lightning strikes, right? Is a good trade because options themselves are little massive leverage instruments. They start at $1 and they go to 20. Not all of them, but some of them. And so my class is going to focus on how you find those particular options and how you capitalize on the big move. And I'll even show you how to do this, where you can say, what if I'm wrong? I can still make money, right? Wouldn't you like to know how to do that? So anyway, the class is the last week in May, and watch the Telegram channels. If you're coming to this and you're watching me, and it's not because you're on the Telegram channels. If you don't have Telegram, I'd strongly recommend you download it. What's Telegram? It's just a better WhatsApp that's not going to try and take your information and give it to Mark Zuckerberg, and it's a cool platform. I quite frankly didn't even know about it before this year started. But getting involved with the Actions to Wealth team, they were using it, and so I joined up. And wow, I'm really impressed. I really like it, and so yeah, cool. Anyway, keep an eye out for that because that'll be announced through those channels among other places. All right. Last thing I told you I wanted to do was show you how to find low-priced stocks, the next good stock that you might want to trade and like to trade. I got just a little bit of time for this. This is something I'll cover at length in the class on low-priced stocks that I'm planning on teaching at the end of June. But here's my first little teaser about it. Let's see. Is this? Can I get that? Just like, yeah, that's a little better. Okay, this is, oh well, one big anyway. No, I don't want that. Sorry, I gotta just be careful with it. There, okay. This is marketchameleon.com. It's you can pay for a subscription to this site. I'm going to show you the stuff that's for free. There's another site called finviz.com, but finviz.com is just merciless in its pop-up ads and stuff. So if you got an ad blocker, that's great. I don't have one here on this computer that I'm sharing my screen with. So option 2, my next fallback is Market Chameleon. I really love these sites, these guys. I have free subscriptions to both of those 2 sites, but I don't have paid subscriptions. I haven't had need to because the data they have, I have elsewhere. However, if I didn't have the data I have through the brokerage accounts that I have, then this one to me, Market Chameleon, that might be something I'd consider because the screeners and their other tools are really nice. So I want to show you how to use their screener. What I do is I come here to price, volume, and technical, and I just do this. Price, performance, I specify below 5. That's below $5, right? The next column over shows, the price performance, 2-day, 3-day, 4-day, 5-day change is above 5%. The next column over, 6-month change is below negative 10%. So what I want is I want one of these low price stocks that's falling. Most of them fall. So no surprise there, right? Up from having fallen down and then all of a sudden turning up. Okay. So that's the dynamic I want. I want to make sure it's trading over 1 million shares. And if I had the opportunity to, I'd also like to sort through and say US stocks only. There's some actually statistical reason for that. Now, just that alone sorts me out of 10,000 stocks down to just 11 stocks that are that way right now. Now, some people really say, well, I don't want to trade companies that are about to go bankrupt. Hey, anything under $5 a share is priced for bankruptcy already. Okay, they're priced for failure. That's why they're down there. If somebody thought that they had a strong chance of success, they would not be trading. They would not be selling the shares down to below $5 a share. Okay, but if you do care about that, then you go to this valuation and profit thing, and there is, or no, I'm sorry, leverage and growth. There it is, and then look for this thing that says sustainable growth, and you would select any positive, and then if I do that, it changes from 11 to just 2. However, I find that this is not highly predictive of a stock going up. It just means that it's going to take longer for it to go down. Now, these stocks don't really have, I mean, these trade opportunities don't really have a lot of runway time on them. These are short-term trades, 3-4 weeks kind of thing. However, there it is. There are 11 stocks that are in this, and let's see if I can go and, well, I'm going to pick a couple of them. So which ones am I looking for? I don't want to go below $1, so I'm not going to look at job. All of this stuff, $1 to $5, that's where I'm interested in. Notice most of these are pharmaceutical stocks, right? Pharma and healthcare. And I can't remember, Helen, I think it was, mentioned there's a lot of healthcare earnings that are going to be coming out this week. And so, yeah, if there's good news from earnings, these small micro cap pharmaceuticals might really do well. See this at 250 and that at 410, 400. That's low volume stuff. Although they have average volumes that are higher, they were low those days. So I'm going to favor some of these ones that are consistently higher. We're going to look at CASI and we'll look at WPG. See if either one of those give us something we can sink our teeth into. All right, CASI. Okay. Now this stock, notice, has just been tanking. It was up here at $3, dropped all the way down to $1.50. Now you kind of like that because what that tells you is, hey, if I do make our upward run, that's where I can move to. I could move from $1.50 or high 1 to over 3. I could literally double. And what period of time are we talking about? Oh, 1 or 2 months. See, it's done that before, right? These big runs. And so, is this is it going to do that? No, I mean it's no guarantee at all. But it's kind of up and down. It's not just tanking. And if this were the tail end of a couple of years of nothing but straight down, then we wouldn't like this stock so much. We'd want to get out of it. But it did have this big green candle, and we've now got. Let me see. Go ahead and stretch that up a little bit and move it up. There we go. We've got this trade set up where if I buy right here at about $1.80, I could put a stop down here around $1.50. Give it a little room, not right underneath it, a little room, but not much. There's no reason. Hey, if this thing keeps trending down, that's not my trade. I want this to be the trend change. See, this jumps up. If I got in here the next 2 or 3 days, I'd want to have my stop right there, and I'd be out. Bummer, but you don't always win it, right? My trade is I get in these kind of things, and if I'm right, boom, 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 up we go, and I'm over $3 within a month. That's the trade setup. You don't know for sure that it's going to happen. Just know it could. And I actually like them to be a little bit better than this, to show more of a sign of, oh, looks like we've opened, and it opened right off the first day. Okay, so real quick, I'm going to do the other one. WPG, Washington Prime Group. Let's see what it's looks like. Okay, so this dropped from 6 clear down into nothing, and it's hard to, yeah, but see, actually this is, oh, and we got earnings. When are earnings? It's estimated to lose $1.75 a share, and I mean, well, of course, it's below $5, so you know it's a terrible stock. It's priced for failure. Don't kid yourself. We're not buying this because we think it's going to the moon. We're thinking it could go to $3 and $4. It could even get back up to $6 if all of a sudden things somehow got better. All we got up here is that it didn't lose $1.75. That's probably going to come after earnings today. If it lost only $1.50 or $1 or less than $1, right? Then hey, you didn't lose as much money as we thought. Maybe you're not a terrible company. That could send this stock right back up into $3 and $4 a share. And so that's just the nature of how these sort of penny stock trade situations work. All right, heading back to NASDAQ, what are we looking at? We did see the Aussie yen break its support. And right out of the gate, what is the NASDAQ doing? Selling. Okay, kind of fits the narrative, got to say it, kind of fits the narrative that I had in mind, that we were, that we still have sellers out there. So the week, we'll see how it goes the rest of the day, but it's starting up to be this sort of negative thing. So I want to end today by telling you that keep an eye out, doomsday is coming. As far as those low cost, low price stocks, again, I'll be talking more about those as we have more opportunity for them. But if IWC drops below the moving average, then stay away. Don't touch it. Now, that's that class. That's the end of June. The options class is the end of May. So keep an eye out for that in your Telegram channels or whatever way you're coming to this. So until next week, as we get closer and closer, inch closer and closer to that doomsday, be very conservative with your trades. Don't enter into huge positions that you think are just going to take off. You will have better opportunities to enter trades, I promise you. And there could be some really good opportunities coming up. But instead, look conservative, watch out, be defensive. And if you know anything about options, consider writing put option trades to the downside. Not terribly aggressive yet, because we're not there, but it is approaching. We're still seeing the signs. Doomsday is on the way. Until we get closer and can talk more about it next week, everyone take care and trade well.